and welcome to Up Your Assets. I'm Ray Ferrara, founder and executive chair of Provise Management Group, LLC, an SEC-registered investment advisor with offices in Clearwater and Tampa, Florida. Welcome to another episode of Up Your Assets. I want to tell you a little bit about our show. This show is not designed to provide personalized advice in any ways. It's general information that we're trying to provide to our listening audience. I also want to disclose to you that our guest today has been a friend of mine for 25 years. He has paid nothing to be on this show. I receive no remuneration from him. He's here to provide education. Should you want to reach out to him at any time, you'll at least have his name and company name, but no endorsements, anything of that nature. But hopefully you'll find this to be an exciting episode on what is typically kind of a boring subject, life insurance. Imagine that, exciting. Well, first of all, let's talk a little bit about the philosophy of having life insurance in the first place. Now, if you're selling life insurance, you're trying to sell as much life insurance as you can with as big a premium as you can to make as much commission as you can. First of all, our belief as financial planners is there's three reasons to have life insurance. The first is in the case of a premature death of the policyholder, to replace that lost income. The second is to pay down debts or to pay down anticipated large expenses, perhaps like a college education of a child. And then thirdly, to pay estate taxes, which comes into play very little given the very high exemption amounts that we have currently. So if you don't have a need to replace income anymore, if you don't have any debts or any anticipated large expenses, and if you don't think you're going to have a large estate where you'll have to pay estate taxes, there's really no reason to buy life insurance at all. And most of the time, we are always recommending term insurance because we believe that there are better things to do with that additional money. Now, I know I just turned off a whole bunch of people out there in the life insurance business, but as a financial planner, that's what I think is in the best interest of our clients most of the time. Exception there would be for estate taxes, which are kind of a permanent problem. So once you've gotten past no longer having to replace income, particularly now you're retired, you've paid off all your debts, you don't have any of those large expenses, and you don't have estate taxes to worry about, what are you going to do with the policy? You're going to continue to pay premiums? Well, that's what a lot of people do. Why? Because we all love to hug those life insurance policies. We paid on them all those years. I don't want to give it up now that I'm older and maybe not as well as I once was. Some people will say, well, I really don't need it anymore, and they'll just cash it in and take whatever cash value it might have if it is that type of policy. And those really have been the two choices that many people have gone to. But over the last 35, 40 years, the life settlements business, where life insurance policies are sold to investors, often pension plans, profit-sharing plans, sometimes to individual investors, has really come into maturity. And it's my pleasure to introduce to you today Boyd Crisler, who is the founder and CEO of Boyd Settlements. Boyd, welcome to Up Your Assets.
Ray, thank you very much. It's great to be here.
Glad to have you. And let's just kind of jump into it. A lot of people may not understand what viatical settlements are, what's now called life settlements. So kind of give us a brief idea of exactly what this whole topic is about and what people can do as a third alternative to just cashing it in and giving it up or continuing to pay those premiums.
Okay. Basically, a quick definition, Ray, would be a life settlement transaction is basically the sale of an existing life insurance policy that gives the policy owner a settlement amount, cash settlement now that's more or in excess of the cash surrender value. So you said something that was critical, that people basically, if they end up with a life insurance policy they don't want or need, traditionally they've either let it lapse or they've just cashed it in for the cash surrender value. This is the third option. being you can sell it just like a house or a car.
Well, how do you get around to actually selling it? Where do you go? Where do you turn? I know there are ads on TV as an example towards this. There's that one with the people down in the mine, and the little old lady is upstairs, and she's hearing these voices and everything. So there's ads out there about it. How do you get from here to there?
Well, that's a good question. And the ads have been very effective. And there's guys like me, and there are not a lot of us, but we're very, very busy. So the awareness of life settlement option has been good for the industry. But basically, Ray, I've been in the business 19 years, and I'll hear about a case before I really get it. And I may get a call from a top tier advisor, someone like a trust company, a CPA, a financial advisor, a insurance agent, or a tax attorney or an estate attorney, and they'll run it by me first, knowing that I have the knowledge to kind of be able to say, you know what, this looks interesting. Let's look at this on behalf of the client and try to take this forward and see if we can help them. But again, having the option to sell it versus lapse or cash it in is really great, and I think very positive for the consumer. You're basically taking an idle asset and creating value or finding the value and turn it into cash for the client. And people love it because you don't really look at a life insurance policy while you're living as having value, but many, many times they do. And sometimes the value can be significant.
So Boyd, I'm going to sell my policy. I'm going to come to someone like you, perhaps attorney. You're working with attorneys, I'm sure, and accountants and financial planners to refer business to you. So let's say I'm the client for the moment, and so one of my worries might be, first of all, why would somebody want to buy the policy from me? I mean, if it wasn't a good deal for me, why could it be a good deal for them? And geez, if somebody's got my policy out there and they know who I am, uh, do I have anything to worry about? Boyd, is Guido going to show up at the door? So help me with that.
Ray, I'll answer the Guido question first. And in 19 years, I've only lost two cases where people didn't feel comfortable. But these policies, the majority of them by far are held in trust on behalf of an institutional investor. It's not that popular for, some guy down the street to own this guy's policy over here. They're held in usually large pools with institutions. That's the first answer. But what would remind me your first question, Ray?
Well, you sort of answered it right there, and that is, why would somebody want to buy it? And you're talking about institutions and trusts and
Okay.
et cetera. So, but why would they be interested in buying it if I didn't think it was a good deal for me? Why would somebody want to pay me all that money?
Right. And it's composed of several different factors. There's the money side, which is, all right, let's look at what the future premiums are for this policy. Let's get an annual statement. Let's get a copy of the policy and do the math. Then there's the medical side where we're going to look at the medical records for the past 5 years. By the way, people don't have to do a physical to go through these transactions, which is very good. We use existing 5-year medical records. But so let's take Mr. Smith, for example, owns $1 million policy. He's 80 years old and he's got 10,000 of cash surrender. So our job now becomes to get him much more than the 10,000 in cash surrender. The premiums on this million are say 35,000. So the buyer will look at the life expectancy, the future premiums, costs associated with the policy, come up with a discount rate, which is the return they need to generate for their institution that is going to probably own this. So they would pay Mr. Smith X number of dollars up front and then continue to pay the 35,000 in premiums until Mr. Smith passes away. Then they get the $1 million. So they're looking for, let's say, a 12 to 14% return, and they would plug it in with the life expectancy and the future premiums and come up with a number.
So it's a little bit of a situation where instead of how healthy I am, it's how unhealthy I might be and how much older I might be in selling the policy. So the older I am, the unhealthier that I am. Geez, is that a word? Unhealthier? Yeah, I guess it is. Then the higher it's going to be because of the greater chance of my life expectancy being shorter. Is that a fair way to look at it?
It is. In fact, there's two ways. There's the lower the future premiums and the shorter the life expectancy equates to a higher offer.
So, what type of policies then are eligible for a life settlement?
You know what, Ray? I've done pretty much all of them. I've done a whole bunch of universal lives. That seems to be the most popular term that can be converted, and also the term that's just left as a term. Variable universal life. Whole life would be the only one that really doesn't get a lot of play because of the requirement to pay premiums every year and the high accumulation of cash surrender value, or actually cash value. But universal life term, convertible terms, and variable universal life are nominally the biggest population of types of policies.
So, does the type of policy, Boyd, does it make any difference as to how much I'm going to get, one way or another, or does that a neutral factor?
It's a neutral factor up to a point, Ray, where let's say someone has a term policy, a 20-year term, and there's a little bit of term left on it, but we have to convert it prior to selling it. When I say convert, take it from a term to a permanent policy, like a universal life. That's an extra step in the process. And there's cost involved going from a term to universal life. But usually when we do those transactions, we're able to negotiate the cost to make that conversion back to the client. So, but in general, they're all kind of valued the same. With a variable, you need to be aware of a gross internal rate of return on the savings account within the variable products. And usually we move the cash into, if there is any, over into a fixed account anyways. So you're close, but there's a little bit of difference, not much though.
Okay, great. So take me through the steps. I'm the client. Let's say I've got that $1 million policy you were talking about before. I don't need it anymore. I've retired. Gosh, I don't want to pay that $35,000 premium every year, on a go forward basis. So how do we get started?
Okay. It's simple. It usually starts again with a conversation with a top tier advisor. And just for everybody that's listening to know, this is a very, very regulated industry. And being in it so long, we have fought for those regulations. Okay, we've had the initial conversations. We want to try to move forward. What's needed? On the medical side, I'm going to send out a HIPAA, and that's going to give me authorization.
But let's stop. That's a health authorization form for the given permission to send the information from your doctor to you or to the company or to the potential investors. Is that right?
That's correct. It's authorization for us to look at past 5 years of medical records, and that drives this industry. You have to have those in place, and so we can look at this and try to help determine this life expectancy. But on running parallel with that, so we get a HIPAA signed, a list of current doctors where we will go and get the last 5 years of medical records. Again, no physical. Running parallel with that is we're going to order illustrations from the insurance company to see what this thing looks like going down the road. And it's interesting at that point, Ray, a lot of people don't know what it's going to look like. And it can be a shock to people to see the cost of the insurance increasing as people get older. But so we're going to go get meds. Then once we get the medical records via the HIPAA, we're going to order a certified life expectancy from a state approved independent third party. These are generally actuarial firms, and they'll factor in any ailments that the potential insured has. So we're getting the HIPAA medical life expectancy, illustrations, annual report, copy of the policy. Then we marry those together and take it to market.
So when you take them to market, you're going to just one person, or do you have a cadre of folks that you can go to? So people are bidding on it so that you can get the highest price possible for the client?
Absolutely. We take it to all, let's say the policy is in the state of Florida. We take it to all state approved buyers in the state of Florida, again, highly regulated, and they're going to do their own internal analysis. They may do a little more underwriting on their own, and they're going to end up bidding on this. And I'm the negotiator and do the heavy lifting to get this ultimately to the highest bid. And once we get to the highest bid, we're comfortable presenting it to the top tier advisor or directly to the client, and they can make a decision on that point at that point. And if they take the offer, Ray, then that would generate the need for closing documents, which will be prepared and executed, some notary signatures, different things, the copy of the policy, copy of driver's license, things like that. And then once it is signed, all the documents are signed, it'll go back to the buyer and they'll do their due diligence, and we'll have to clean up any documents if we made a small error. And once all that's done, money will go into escrow, change forms go to the insurance company. And once the changes are executed to the benefit of the new owner, then they'll release the funds to the client. It doesn't stop there though, because after the client is funded, they get their money, they have a 15-day rescission to change their mind. It's only happened once in 19 years with me, but it's there to protect the consumer.
So, you just gave me a lot more comfort to ask that question about Guido earlier. So I did not realize, I knew you were regulated, but I didn't realize that the state of Florida has approved buyers on the other side. So there is some, I don't want to say protection because there's really not protection, but there is some regulation on the buyer side as well as on the broker side, like yourself.
Absolutely. And actually, to go even further, Ray, the forms that we use in closing are approved by the state of Florida. So we have invited increased regulation on this industry for years. And again, anything that we do needs to have the client in mind. And we've succeeded. There's always more work to be done, but that's our goal, is to be regarded as a really good helping industry for consumers.
So, when you sell something, sometimes you make a profit. So, and sometimes not. But how does it work with life insurance when you sell it? If you die, life insurance is paid to the beneficiary and it's income tax free in most cases. What are the tax ramifications if I sell it prior to my death?
Okay. And of course, a disclaimer that I'm not an accountant, but I can tell you that people, let's say someone's bought a policy and they've been paying on it for 10 or 15 years. Those premiums now become as cost basis into the policy, which is non-taxable. So very rarely do we get in a situation where they're basically recovering costs. It's not an industry to make profit. It's let's get back some of the money you've paid in instead of just letting it lapse or cashing it in. And then anything above the cost basis, Ray, is 90% of the time is looked at as long-term capital gains. And to go a little bit further, the buyer will issue the seller a 1099 LS, which obviously stands for life settlement. And then the insurance company will issue an SB seller basis. So you can take those two and take them to your accountant and let them, handle the if there's any taxes. But usually it's mainly a recovery of cost exercise.
So I get back all the premiums I paid and there's no taxes on it because it's kind of like that's what I paid for the investment in the first place. And then anything over that is taxed. And you say generally it's taxed as capital gains. Is that correct? Did I understand that correctly?
That is correct, Wage.
There's obviously, obviously, hopefully lower than whatever the income taxes are that you're paying.
Yes, it's favorably towards the consumer, in our opinion.
Yeah, Boyd. So let's take a look at a couple of examples of
Okay.
cases that you've worked with. As we were getting ready for the show, you mentioned to me that you work closely with elder law attorneys. And I think the first case is one that was referred to you by an elder law attorney.
Actually, Ray, it was the elder law's personal policy, the elder attorney's
Wow.
personal. Yes, and it was an interesting case, and I enjoyed working with he and his wife on this. But it was a $500,000 10-year term policy. The insurance company was protective, but the policy was about to term out. And term is an interesting animal because you've got level premiums, usually inexpensive. And once you reach that 15-year mark, the policy can continue. It's just astronomical increase in premiums that really no one ever keeps them going. So they just disappear. They lapse them. So anyways, this particular case had the ability to convert. We were within the time frame to convert this policy. So we had to go to the carrier and, get some conversion illustrations run so that we could see what that looked like. But his term premiums were around $8,000 a year. The new converted premiums were going to be about $30,000 a year. So a big increase, but this keeps this policy going to age 100. And he didn't want to pay the increase. So, and we understood. He had some medical issues. We can leave it at that. But he had a life expectancy of let's just say less than 10 years. And we had to fix this policy before we could go to market. And we went ahead and converted it, took it to market. So we had a term policy when he contacted us that was worth zero. And he ended up getting $80,000 plus a prorated reimbursement of what it cost to convert it. So he came out really, really well, only months before this policy would have basically termed out and have been worth zero. So $80,000 is more than zero, and he was very happy.
So the first thing we have to do is that we have a term insurance policy. We have to think in terms of, is it convertible into another type of insurance? If it isn't, from what I heard you say, if it isn't convertible, then that's an issue that the policy would have to still be worth zero. Is that a fair statement?
The only way it would be worth something, Ray, is that let's say there's term left on it and the person has cancer and they're only going to live X number of years, and that was well within the term, that could be sold. But, it's heartbreaking that people need to really keep in touch with their top tier advisors to really understand the term policy and how late can they go paying the term before the term conversion ends. And that's in the table of contents of your policy. But the ability to convert it is always good in where we work on our side. So this happened to be within the limits of conversion, the time frame of being able to convert. And the net result is a lot of money for the client that he wasn't going to get had he not called us and gotten us involved.
All right, great. Give us another example of where you have worked with someone in converting their policy over to a life settlement.
Well, this is an interesting one. It's a simple one, but it's near and dear to my heart, especially with the advertisements you see on TV. And I was approached by a gentleman several years ago, and his wife had passed away, and his children were grown and successful and had lives of their own. And he had a $400,000 life insurance policy. He was 78 years old, and the premiums were relatively inexpensive at $15,000 a year. And he said, what could we do? Oh, by the way, Ray, he had about 3,000 of cash surrender value inside this policy. So it was universal life. And I said, your options are this. One, you can take the 3,000 and the insurance company will tear up the contract. You won't pay any more premiums, but there'll be no death benefit payable to a beneficiary. That was option one. Option two would be to call the groups on TV that they're say a rapid quote or direct buyer type situation, and maybe would get 20,000 from them. He ended up going with me, and I got him 65,000. So look at the 3,000 from the carrier. Let's just say 20 or 25 from a TV buyer, and 65,000 from someone that really digs into the case and does it the right way and gets him a lot more money. So that one's near and dear to me.
One thing I want to be sure to talk about as we look at these examples, a lot of folks back in the early 90s and up until, maybe 10 years or so ago, bought life insurance to help pay for those estate taxes that I talked about at the beginning of the show. And now with the change in the tax law that occurred in 2017 and potentially might continue as we go forward here in 2025, no longer have a taxable estate. And yet they've got this policy inside of the trust and paying premiums on it on a regular basis. Often it's a second to die, meaning after both of the spouses pass away, the policy pays off. Is there an opportunity there to sell that kind of a policy as well?
Absolutely, Ray. Second to dies are very popular in what I do, and a lot of times they're held in a trust, an ILET. And why do people sell these policies? Usually it's because they cost too much now. They've gotten older. They need the money. So money is the main factor. But maybe the policy's not performing like they thought, or their health has changed. They've had a decline in health. They need to generate cash to go into assisted living or some sort of medical assistance. Maybe they've been divorced, or maybe they've sold their business and they had a life insurance policy in the business. We're doing one of those right now where we're going to pull the life policy out and let these people sell their business. But you hit on one that's very interesting, and that is some people have accumulated a lot of wealth, and they bought something 15, 20 years ago, and now their wealth is so high that is not going to achieve what they set out to achieve. They don't really need it. They're basically self-insured. And those type of clients, we do a lot of those type of cases where the accumulation of wealth negates the need for the policy they bought 20 years ago. It's a good story, though.
Speaking of stories, I know you've got one more. So how about share another example with us?
I will. And this is me, one of the most interesting. It's a very wealthy client. They owned a 5 million Universal. The company was Transamerica, but she was 94 years old. So she's up there. And this is a very complicated case. The premiums were super expensive because they underfunded policy early on. There was no real cash value because they're making minimum payments to keep this thing barely hanging on. But we sold it for $2.2 million, which is a large amount of money. The takeaway on that is the older a client gets, what's inside the policy is that you and I look at is the cost of the insurance, not necessarily the premiums. And because this was underfunded, the cost of the insurance, especially for older clients, say 80 years and above, has to really be watched. And we really helped. This was again, a complicated case, took about 6 months, but to get her 2.2 million, she was thrilled.
Well, Boyd, I want to thank you very much for being with us today here at Up Your Assets, letting folks know that there is a third alternative to continuing to pay the premiums or cash out the policy, and that's a life settlement. And it's great that we're able to explain to folks exactly how that works. So I really want to thank you for being with us today at Up Your Assets.
Well, thank you very much, Ray. I appreciate it very much. And I hope people got something out of this.
I do as well, and I'm sure they did. So this is Ray Ferrara with Up Your Assets. Just want to remind everybody, Boyd did not pay anything to be here. I in no way share in anything that he does, and never have, and we have referred people to him over the years. But he does it like a fiduciary, and he does it in your best interest. So this is the sixth episode of Up Your Assets, and we'll be back to you in another 2 weeks with another episode of Up Your Assets.